It's time now to see what's making business and financial news. World markets rallying on the news that the U.S. and China are headed back to the negotiating table. For more, we can speak to France 24's business editor, Brian Quinn.
Well, Will, Beijing and Washington, of course, have agreed to hold trade talks in early October. Those negotiations planned for Washington, D.C. at a ministerial level, top level. That would be the first time such meetings are happening since they fell apart in July. That led Donald Trump to slap tariffs on more or less all Chinese imports to the U.S. So far, no sign that October's meeting will convince Trump to lift the latest round of 15% tariffs imposed just this past Sunday, or to head off a planned hike of existing tariffs scheduled to take effect next month. Meanwhile, Beijing is maintaining its complaint against U.S. trade practices filed with the World Trade Organization earlier this week. Here's their Commerce Ministry spokesman.
The U.S. tariff measures against Chinese imports seriously violate the rules of free trade and the multilateral trading system. China's complaint against the U.S. at the WTO is a bid to protect its own legitimate rights and interests and to defend the multilateral trading system.
The global stock market quite pleased to hear those talks are back on. The Dow finished up 350 points in Thursday's session. Over in Asia, Tokyo's Nikkei index ending the day up just over 0.5% as consumer spending grows, although a bit slower than expected. Chinese indexes climbing as well. The Shanghai Composite and Hong Kong's Hang Seng both up just over 0.4%. Kospi and Seoul closing the day up just under 0.25%. European indexes opening mixed as Brexit uncertainty continues to weigh on investor sentiment. London's FTSE 100 down around 0.25%. The CAC 40 here in Paris opening just under the flat line. Frankfurt DAX is up just under 0.2% at the open. Well, next, the world's largest oil companies are continuing to invest in major new extraction projects that are at odds with the Paris Climate Accords. That's the finding of a new report out Friday from a think tank led by former energy industry insiders. $50 billion in investments last year alone are likely to either be stranded in non-viable operations if emissions targets are enforced, or help push the climate into runaway warming if they are not. Solange Mujan reports.
Undermining global efforts to curb climate change. The financial think tank Carbon Tracker found that last year, at least 30% of investments by big oil and gas companies were spent on new projects that are not in line with the Paris Climate Accord. Over a dozen energy firms like ExxonMobil, Shell, Chevron, and BP spent some $50 billion in 2018 on projects that would not be sustainable in a low-carbon world. The study found both an environmental risk but also a financial one.
Every oil major is betting heavily against a 1.5 degrees Celsius world and investing in projects that are contrary to the Paris goals. Investors should challenge companies' spending on new fossil fuel production.
The non-profit found that if governments do manage to take tougher emissions stances, then major gas and oil companies could be wasting some $2.2 trillion by 2030 in projects that are no longer financially viable. And the study contradicts the green rhetoric of many oil executives. Many companies refused to comment on the report, but Shell did respond.
As the energy system evolves, so is our business to provide the mix of products that our customers need and ensure that Shell continues to be a world-class investment case.
The industry says they need new projects to meet rising demand in Asian economies. While many companies have upped investments in renewable energies, a sector that's booming, they're also hedging their bets on oil and gas.
So clearly ways to go to enforcing those climate goals. Well, we'll be keeping an eye on that.
Yeah, sadly a long way off. Thank you, Brian. Brian Quinn with a look at the business news.